Can just $100 a month make you rich in the stock market? It might sound far-fetched. After all, $100 is what many of us spend on a phone bill or a nice dinner. But what if that same $100 invested every month could grow into hundreds of thousands of dollars, or even more, over time? In this video, we're diving into that very question. We'll explore how investing $100 per month, especially in a broad U.S. stock index like the S&P 500, can build wealth through the power of compounding. Along the way, we'll break down key concepts: compound interest, dollar cost averaging, inflation, market cycles, in simple terms. By the end, you'll see how consistent investing, even with a small amount, can potentially make you stock market rich in the long run. Let's start with the superstar of long-term investing, compound interest. Often called the eighth wonder of the world, a phrase famously attributed to Einstein, compound interest is basically interest earning on top of interest. Think of a snowball rolling downhill. It starts small, but as it keeps rolling, it picks up more snow, in our case, interest, on every rotation, growing faster and faster. In investing terms, this means the returns you earn get reinvested, so those returns begin to earn more returns, and so on. For example, say you invest $100 and it earns a 10% return in a year. You'd have $110. Next year, that $110 earns 10% again, giving you $121. You gained $11 in the second year, not just $10, because your past profit also earned money. Over many years, this effect explodes growth exponentially. It's how small, consistent contributions can lead to surprisingly big sums. Crucially, time is your best friend. The longer your money stays invested, the more compounding works its magic. Even if you're only investing $100 each month, given enough years, the growth can be remarkable. In short, compound interest is the engine that can turn modest investments into substantial wealth. It's the key to getting rich slowly but surely. Now, investing $100 per month is an example of dollar cost averaging in action. Dollar cost averaging means investing a fixed amount at regular intervals, no matter what the market is doing. By putting in $100 every month, you're automatically following this strategy. Why is that powerful? Because dollar cost averaging takes the guesswork out of timing the market. Instead of worrying whether stock prices are high or low in a given month, you just keep investing your $100. Sometimes you'll buy when prices are up, and sometimes when they're down. But over time, your cost basis averages out. This approach has two big benefits for beginners. 1. Reduced emotional stress. You're not constantly trying to pick the perfect moment to invest, which is nearly impossible to time consistently. You just invest routinely, like clockwork. 2. Buying more shares low. When the market drops, your $100 actually buys more shares since prices are lower. When the market is expensive, your $100 buys fewer shares. In the long run, this can lower your average purchase price and cushion the impact of volatility. Financial experts often recommend dollar cost averaging for its simplicity and risk-reducing benefits. It's a set-it-and-forget-it method that keeps you investing through all market conditions. And as we'll see, sticking to that consistent $100 per month plan through good times and bad is exactly how you harness the market's long-term growth. You might be wondering, why do we keep talking about a 10% return? Where does that number come from? When we reference approximately 10%, We're talking about the historical average return of the U.S. stock market, typically measured by the S&P 500 index. The S&P 500, an index of 500 of the largest U.S. companies, has historically returned around 10% per year on average. This 10% is a long-term annualized figure, meaning over many decades the up and downs have averaged out to roughly 10% gain each year. Importantly, that 10% includes the effect of reinvested dividends. When companies in the index pay dividends, and you reinvest those dividends to buy more shares, it boosts your overall return. Fun fact: from 1940 to 2024, roughly 34% of the S&P 500's total gains came from dividends being reinvested. That's about one-third of the growth coming from those steady dividend payouts. Now, 10% is an average, not a promise. Some decades the market returns were higher. For example, past 50 years saw about 11% annually with dividends, and some periods were lower. But for planning purposes, many investors use an 8 to 10% annual return assumption for the U.S. stock market. And crucially, that 10% is nominal return, not adjusted for inflation. We have to talk about inflation's impact next, because 10% growth minus inflation is the real increase in purchasing power. Inflation is the gradual rise in prices over time. Basically, it makes money worth a little less each year in terms of buying power. Why does this matter for our $100 per month strategy? Because when we say the market returns around 10% on average, that's before accounting for inflation. Historically, inflation in the U.S. might average around 2 to 3% per year. So the real return, after inflation, of the stock market has been lower, roughly in the 6 to 7% range on average. Here's a striking example. If you had invested $100 in the S&P 500 back in 1957 and reinvested dividends, by mid-2025, that single $100 would have grown to about $82,000 nominally. Sounds amazing, right? But adjust for all those decades of inflation, and in today's dollars, it's around $7,100 of purchasing power. $7,100 is still a huge increase from $100, but it shows how inflation eats into the nominal gains. For our $100 per month scenario, inflation means that the $531,000 we might accumulate after 40 years, at 10% returns, won't buy as much in 40 years as $531,000 would buy today. If inflation averages approximately 3%, that $531,000 might be equivalent to maybe $160,000 to $200,000 in today's money, in terms of what you can purchase. The good news is that stock market investments tend to outpace inflation significantly. That's why investing is critical for growing wealth above the cost of living. While inflation quietly erodes cash savings, investing in stocks helps you stay ahead of inflation over the long run. Just be aware that getting rich on paper isn't the same as real purchasing power. But by investing, you give yourself a far better chance at real wealth than if you left money in cash. Investing isn't a smooth ride. The stock market is volatile. That means there will be bull markets, when stocks climb and portfolios balloon, and bear markets, when stocks fall and your portfolio can temporarily shrink. This is normal. Even though the S&P 500 has averaged approximately 10% over many decades, those decades were filled with wild swings. There were years with spectacular gains and years with gut-wrenching losses. Behind the average gains lies a history of booms and busts. For instance, consider the 21st century so far. We had the dot-com crash around 2000 to 2002. market fell nearly 50%. The 2008 financial crisis. Market crashed around from 2007 peak to early 2009, and the quick crash in early 2020 due to COVID, an approximate 34% drop. Yet, after each downturn, the market recovered to reach new highs. In fact, following the 2008-9 crash, the S&P 500 went on its longest bull market run in history, from 2009 to 2020, rising about 330% over that decade of recovery and growth. Every major decline in the market's history has eventually been followed by an upswing to new records. The catch is, you have to stay invested to benefit from that recovery. So what does this mean for someone investing $100 a month? It means you'll experience some roller coaster moments. Your account balance will not just steadily climb in a straight line. There will be periods where it might stagnate or drop during market crashes. This is where mindset is key. Remember that volatility is normal. Downturns are not a signal to quit. In fact, for a consistent investor, a market drop can be an opportunity. You're buying shares on sale with your continued monthly contributions. History shows that if you keep investing through the downturns, the rebounds can dramatically boost your long-term results. You end up buying low during the bad times and reaping the rewards in the good times. One more thing. Don't be disheartened by early, slow progress. In the first few years of investing $100 a month, your gains will be modest, and a big drop could even make your balance look disappointing. But as the years go on, compounding and market growth tend to accelerate your portfolio's expansion. The last 10 years of your plan will likely contribute far more growth than the first 10 years. Patience pays off in investing. Remember, we're looking at a multi-decade journey. Let's get to the exciting part, the numbers. Suppose you invest $100 per month in an S&P 500 index fund, and the market returns a 10% average yearly return roughly in line with historical averages. How much money might you have down the road? Let's break it down by time invested. After 10 years, you would have contributed $12,000. Thanks to compounding, your investment could grow to roughly $20,000 plus. It's not jaw-dropping yet, but you've already nearly doubled your money in a decade just by steady investing. Not bad. After 20 years, you would have put in $24,000 total. The portfolio might reach around $69,000. Now the effect of compound interest is more visible. Over $45,000 of that is growth. After 30 years, you've invested $36,000. Your balance might be roughly $197,000. Here, the growth vastly exceeds the $36,000 you put in. This is the power of decades in the market. After 40 years, you've invested $48,000 over 4 decades. Astoundingly, the portfolio could be around $531,000, over $500,000 from that $100 a month habit. The vast bulk of that money, approximately $483,000, is compound earnings on top of your contributions. These figures assume a steady 10% average return and all gains reinvested. Real life will be bumpier. Some years the 10% return won't happen, but it gives a ballpark idea of what's possible. By 40 years, you can see how the curve really skyrockets. The difference between 30 and 40 years, an extra decade, is enormous. About $334,000 more in that example, nearly doubling the 30-year amount. That's compounding for you. Let's summarize and add a couple of tips to make the most of your $100 per month investment plan. Start as early as possible. Time in the market beats timing the market. The earlier you start, the more compounding does the heavy lifting. Even a 10-year head start can mean the difference of tens of thousands of dollars down the road. The lesson: the best time to start was yesterday. The second best time is today. Reinvest dividends. If your fund pays dividends, reinvest them. Don't cash them out. Reinvesting dividends buys you more shares, which in turn produce more dividends and growth, that snowball effect we talked about. A huge chunk of long-term gains comes from dividends being plowed back in. Stay consistent, especially in down markets. Stick to your $100 per month plan, no matter what the headlines say. Market crash? Keep investing. You're buying at discount prices. Market roaring? Keep investing. Enjoy the ride, but don't get tempted to skip contributions. The DCA strategy will smooth out the ride and ensure you're always participating. Historically, those who continued investing regularly through bear markets reaped big rewards in the subsequent recoveries. Keep a long-term mindset. Remember that this is a decades-long journey. Don't panic if after a year or two you don't see huge results, or if your account dips during a rough year. Wealth building is a marathon, not a sprint. The real magic happens later on, as we saw with the 30 and 40-year figures. Try to view your portfolio as money for the future, not something to touch or judge too much in the short term. This mindset will help you stay the course. Scale up if you can. If $100 a month is comfortable, consider increasing it over time. Even an extra $50 or $100 a month when you can afford it will supercharge your path to rich. But even if you never increase it, know that your steady hundreds are working hard for you in the background. So, can you get rich investing $100 per month in the stock market? If by rich we mean building real wealth over time, the answer is a resounding yes. $100 a month may not sound like much, but as we've seen, when compounded over decades at market returns, it can potentially grow into hundreds of thousands of dollars, even touching the millionaire range in favorable scenarios. The journey won't be flashy or fast. It's a slow grow, but it's highly effective. The combination of regular contributions, reinvested dividends, and the long-term growth of the S&P 500 is extraordinarily powerful for wealth building. For beginners watching, this should be great news. You don't need a trust fund or lottery win to secure your financial future. What you do need is consistency. Automate that $100 investment each month. Learn the basics as you go, and stay the course. Imagine yourself 30 or 40 years from now, looking at a portfolio that has grown from your simple habit of investing a small sum regularly. That could be a game changer for your retirement, your family, or any financial goals you have. The earlier you start, the bigger the potential payoff. If you found this video helpful, don't forget to like and subscribe for more simple finance insights. Cheers.